Hi, I'm James Robinson, and this is a Robinson Stocks stock pick. This is the fourth video in my five-part series on the company Maine Foods, symbol CALM. Today we're going to talk about dividends for this company. And before I get too deep into it, I'm not buying this company as a dividend play. The dividends for the last couple of years have actually been pretty good. They're north of 4%, but there's no history of them being a good dividend paying stock. And as a result, if I was someone who was looking for stocks that I could retire on that are going to pay enough dividends to fund my retirement, this is not a company I would suggest you choose. Having said that, I'll go through the exercise of talking about this company's dividends so that you have that information. So here you can see a chart of the dividends for the stock, and you can see that there is no consistency to the dividends at all. They gyrate pretty significantly, and they really gyrate based on the company's performance. And this is obviously not acceptable if you're a dividend investor, somebody who's looking to create a budget based on the dividends your companies pay. In this case, dividends are simply a happy accident that you get for owning the company, not something you should count on as an investor as a way of modulating your returns. So before I go through these next few slides, I want to talk about what I look for when I'm looking at dividends. The first thing I look for is yield and growth. So I'm looking for the return on investment you would get if you bought the stock in terms of dividend yield. And then I'm looking for that yield to be growing, the dividend itself to be growing over time, preferably at a rate that's significantly above inflation, so that our cash flows can make us wealthier over time if we're a dividend investor. The next thing I'm looking for is safety of the dividends. How confident am I that those dividends can continue to get paid? The first thing I do there is look at dividend safety in the context of earnings. What's the payout ratio? How likely is the company going to be able to continue to pay those dividends in the long term? Next, I look at dividend safety in the context of cash flow, same thing. And finally, I look at dividend safety in the context of the current debt load. What I'm looking at here is if interest rates were to dramatically increase, obviously the debt service would increase, and how likely is it, or at what point does the debt service start to absorb all the money that we could have used for dividends? And so those are the things we're going to look at in the next few slides. So here you can see a chart of the dividends. The blue line is the dividends per share. The red bars are the amount of increase. In this case, it doesn't seem to make much sense, but I'll just walk you through it. The dividend right now, the company's paying about a 4.7% dividend. Again, I don't know that you can count on that. However, the S&P 500's average dividend is 1.22%. So it's about 4 times the dividend of the S&P 500, at least currently. I also, by the way, do think this dividend is likely to continue for some foreseeable future because the company has $700 million in cash. And at some point, they need to be paying that to the shareholders. So while I say I wouldn't buy this company as a dividend stock, I actually happen to think better than a 50-50 chance that this company will be paying dividends for the next few years at the very least. Having said that, as a dividend investor, that's not certain enough for me. It's hard to measure the dividend growth for the last 5 years because 5 years ago, the company paid no dividends. The dividends have dramatically gyrated. And so I'm just going to say that this company doesn't really have any growth in dividends because you can't count on it. So dividend safety in the context of earnings. So what we're really saying here is for every dollar of earnings, how many pennies or what percentage of that money is going to pay dividends? If that number is too high, let's say 95% of earnings went to pay dividends, then that dividend becomes very unsustainable because if the company has a bad year in earnings, it's going to reduce the dividends. And the lower that number is, the more likely that those dividends can continue to get paid. So the current dividend payout ratio is 33%. Under normal circumstances, I would say that's a very secure number. It's a number that means the company should be able to sustain even a significant drop in earnings and be able to continue to pay that dividend. To put that in context, the dividend pay ratio for the last 5 years has been 31%, but the earnings have gyrated a little bit over that time. Also, the average payout ratio of the S&P 500 is around 35%. So this company is a little more conservative in the way they pay out dividends than the S&P 500. And I don't think the S&P 500 is very good at paying dividends. So again, I don't really look at this company as a dividend stock, as this slide shows. And this slide is talking about dividend safety in the context of free cash flow. The payout ratio from free cash flow of this company is about 30%. That's very sustainable. The average payout ratio for the last 5 years is about 14.8%, even more sustainable. The problem is that the earnings during that period of time have gyrated pretty significantly. So let's just sort of take 2024 and explain what we're looking at here with this chart. Cash flow from operating activities was $451 million. They spent $147 million of that on capital expenditures. I'm going to talk more about that in a second. They had left them with free cash flow of $304 million. They paid $91 million in dividends, which works out to a payout ratio of 30.2%. One other thing that I think we should talk about here is the capital expenditures. Those numbers have been significantly higher for the last 2 years. One of their largest customers is McDonald's, and McDonald's has recently said that they won't buy any eggs from companies that are not producing their eggs in a cage-free environment. As a result of that, this company's had to spend a tremendous amount of money on infrastructure and capital expenditures to create the flock, if you will, of hens which are not caged. I think that expenditure is almost over, and I would expect to see this capital expenditures number drop over the next couple of years. This slide's a little bit confusing, so I'll try and go through it and explain what I'm doing here. One of the things which can in fact impact a company's ability to pay dividends is the amount of debt they carry. The problem with carrying debt is that often or occasionally interest rates can raise and sometimes rise dramatically, and when they do, the fact that you'd have to pay more interest might impact your ability to pay dividends. So what this slide is doing is really kind of calculating out how that would work. So for example, this country currently pays less than 4% on its debt. Let's assume that the debt went up to 4%, the carry cost on that debt. That would mean that there'd be $5.8 million less money to pay dividends because they're paying that additional money in interest. The new adjusted cash flow would be $298 million from what it was. That would put the dividends we're spending are $91 million, which means you'd have $206 million in cash flow after paying dividends, which means you got a payout ratio of about 30%. That's all fine. That's no problem at all. But interest rates, let's say interest rates went to 15%, then you'd have a reduction of $23 million in cash flow, which reduces your cash flow to $280 million. Again, you're paying $91 million in dividends, leaves $188 million in cash flow, and your payout ratio only goes up to 32%. The point here is, in this case, this company has so little debt that even a massive increase in interest payments isn't going to hurt your ability to pay dividends. That's one of the reasons that I really look for companies with no debt. Right now, we've lived and have lived for a long time in a very low interest rate environment. But in my lifetime, in the 80s, interest rates got to 15, 16, 18%. And if you're not budgeting that might happen, I don't think you're doing a good job of reducing your risk, especially if you're a dividend investor who is looking at these dividends to fund your lifestyle, right? So we want to make sure this thing's rock solid. So in this case, again, there's so little debt, some change in interest rate is simply not going to affect your dividend payment. But there will be lots of companies that if you looked at through this analysis, you would find that even a minor increase in debt carry cost could significantly impact the company's ability to pay dividends. So that does it for the dividends for Cal Maine. Again, I don't love this company as a dividend play. Right now we're getting a dividend. It's nice. I'll take it. I actually think it will continue for a few more years, but I can't predict what's going to happen with it long term. And so to me, I would be buying this company because I think it's undervalued and I think it's going to go up in value, not because I want to get a dividend I can harvest for the next 20 years, for example. So thank you very much for your time.